Hello, welcome to Accounting 2010 Chapter 5 videos. In video 2, we are going to be recording the sales as was started with our purchases in video 1 of Chapter 5. And for this demonstration, we will be using the perpetual method. So in video 1, we had recorded the the purchases. Roadrunner's Roost had made some purchases, and Roadrunner's Roost is a retailer. It purchased some workbooks, and it is going to be selling them to their clients. And so we are going to be recording the sales and trying to find out what kind of a profit we made out of the off of our workbooks. We have only one inventory account at Roadrunner's Roost, and right now we only have one product. We had discussed that with recording a purchase, we only needed one journal entry to record the inventory coming into the store and the fact that we now had sent cash out the door or had created an account payable. In video 2, we're going to discover that we're going to need two journal entries to record a sale. And in those journal entries, one, we are going to be recording whether or not we got cash or created an account receivable. We will be recording the sales revenue that we had just made, the new revenue. We will record the removal of the inventory from our shelves, and we will record the cost of the sale. So in order to do this, we're going to continue with the problem of Roadrunner's Roost. And Roadrunner's Roost had to make a decision of how much to sell their study workbooks for. And they decided that they would sell the workbooks, their $25 cost on the original cost on the workbooks, for $35 each. And their first sale was going to be for 10 workbooks to the MSU Denver Access Center. And the Access Center was going to use these workbooks to help in their study sessions. The sale will be on account. We're going to allow the Access Center to charge these workbooks, and we will offer them a 1% discount if paid in 15 days, but we also wanted them to know that their bill was absolutely due in 30 days. And the Access Center will take advantage of the discount. So in this problem, the Access Center will take advantage of the discount, and there will be no shipping involved. So to begin with, we're going to have to realize that we need to record those two journal entries to simply enter the sale into our books. In order to do that, I'm going to go ahead and go out to the general journal and talk you through it this way. So in order to record a sale, we first have to decide, did we get cash, or are we going to allow our customers to charge it? And we will allow the ability to charge based on the credit history of the customer. Perhaps do we want to increase our sales? We'll allow people to charge. We might be a new business getting started, or we're in a slump time. So we're going to have some decisions to make. But we know that the Access Center will pay us, so we're going to allow them to charge it. So if we had simply gotten cash, we would have recorded the sale, those 10 workbooks, at $35 each, cash coming in the door, $350, and record now that we've made a sale, $350. Cash on the balance sheet, assets have increased, sales on the income statement. Now we have a sale of which to record if we're going to have some net income for the period. In the case of the Roadrunner's Roost sale, it was on account, so we have accounts receivable went up $350, sales revenue is still recorded. If we look at the ledger, the general ledger, we will notice that we can then enter in this data into the general ledger. And in the general ledger, we have the merchandise inventory account. We have now an accounts receivable MSU Denver Access Center. We'll go ahead and capitalize that center. And we have the cash account. Now no cash came in, but we also have to set up the sales revenue account. So I'm going to go ahead and set that up. And so from this account, we can start to record our sales revenue. So I'm just going to format it for a minute. We're going to add a border, and we are going to add another border. And now we have the ability to create a sales revenue ledger account. So based on the first half of recording the sale, we are going to enter in that we have just increased our accounts receivable with the Access Center by $350, and we are going to enter in the new revenue that we have recorded. Now that's only half of the journal entry. This records the sales revenue, but it does not talk about the fact that we have now taken 10 workbooks off our shelves. How do we record that? Well, we do it with entering first the fact that we had a cost associated with those workbooks. What was the cost of those workbooks? We had originally purchased them for $25 each, but is that the cost that now remains after discounts and returns? Let's take a look. We still have 100 workbooks, but the cost associated with them is $2,205. So what is the actual cost associated with each one of those workbooks? Well, if we take the 2,205, divide that by 100, we have now a cost of $2,205 that we will allocate to those workbooks. So we're going to record a debit to the cost of goods sold or COGS of 10 times the 2205. If we go 10 times 2205, we will find $220.50 is the cost associated with those workbooks. And now 220.5 of the inventory costs have now gone out the door, and so we need to take that inventory, remove that cost associated with that inventory off of our books. So let's go ahead and take that into the ledger. We have that inventory. We're removing 220.5 of the inventory. So then we can see that the cost in our inventory, the value of our inventory, is now down to $1,984.50. We need to set up another account. I'll go ahead and copy this. What account do we have to set up? We have to set up the COGS account, right? We have to now record the COGS account. So let's go ahead and set up the ledger account for COGS of the 20. It's an expense, so it will be entered on the debit side. And now we can see what would be our profit off of the sales revenue minus the cost of that goods sold. Well, if we take the 350 minus the cost of the goods sold, we have a profit of $129.50 off of the sale of those 10 workbooks. And this accounts at this point for all of the costs that had flowed through inventory when we had established the purchases. We are now entering those cost of goods sold at the cost to us. So now we're going to have to deal with the fact that we wants to take advantage of them being able to get a discount at the time that they pay us. So how much does the Access Center owe us? Let's go ahead and look in our ledger. If they are able to take advantage of a discount, what was that discount that we were offering them? I believe that it was, if we look, we had a 1% discount if paid within 15 days. So 1% of the 350 is equal to $3.50. So the Access Center is going to be able to reduce how much they owe us, how much cash they have to send to us, the check they have to write to us, by $3.50. So in order to write the journal entry, we are going to have to record that we got cash in the door. And how much cash did we get in the door? 350 divided 350 minus 3.5 cents. $346.50 is the amount of cash that the Access Center will be sending to us in order to settle up their accounts receivable. However, they do get to take off the books, off of their books, the entire amount, and we will be removing the entire amount from the accounts receivable, that they have with us, the entire $350. $350. And where do we put that difference? That difference between the $350 that they had owed us versus the $346.50 that they sent us in the mail to pay off their bill? Well, we are going to give them a sales discount. We're going to record that sales discount. Sales discounts are contra revenue accounts. They are subtracted from the sales account to come up with a net sales. And so we will record that $3.50 as a sales discount. And then the left will equal the right. We've removed the receivable off the books. They would have also removed their payable off the books. We record we got cash in the door. We record the sales discount. And if we go ahead and finalize this in the ledger, we can go ahead and remove the Access Center's $350 off the books. We can record that we got the cash in the door of the $346.50, and we would have a sales discount ledger account, and I'll go ahead and set that up very quickly. It's a contra revenue account, and so therefore we are going to have it naturally entered on the debit side. Go ahead and delete this. The debit of the $3.50, our sales discount, that would have given us net sales of and equal to the amount of cash that came in the door, the $346.50. $350 minus the 3.5 cents discount gives us $346.50 of net sales revenue. And in this example, you have seen how all the costs have flowed through, both for purchases and sales, as are related for Roadrunners Roost and their workbooks. In video 3, we're going to talk a little bit further about the multi-step versus single-step income statement, and that will finalize our work for Chapter 5.